What's going on, everybody? This is Coach Wade, and today I want to answer one of the most common investment questions I hear. What is an index fund? Now, if you ever heard someone say you should invest in an index fund, but you weren't exactly sure what they meant, you're not alone. The good news is an index fund is actually one of the simplest investment concepts to understand. And for many long-term investors, it's one of the most powerful. Let's start with the basics. An index fund is simply a type of investment that's designed to track the performance of a specific market index. Now, you may be wondering, Coach Wade, what is an index? Think of an index as a scoreboard. Just like the scoreboard tells you how a basketball game is going, an index tells you how a group of investments is performing. For example, one of the most well-known indexes is the S&P 500. The S&P 500 tracks approximately 500 of the largest publicly traded companies in the United States. Companies like Apple, Microsoft, Amazon, Nvidia, and hundreds of others. When people say the market was up today, many times they're referring to indexes like the S&P 500. So here's where an index fund comes in. Instead of trying to pick one winning company, an index fund simply buys shares of all or most of the companies in that index. Think about that. Instead of betting on one business, you're investing in hundreds of businesses at the same time. That's called diversification. And diversification is one of the smartest ways to reduce investment risk. Imagine this. Suppose you invested all your money into one company. If that company struggles, your investment could struggle too. But if you invested in hundreds of companies across different industries, one company's bad year doesn't necessarily ruin your entire portfolio. That's one of the reasons index funds have become so popular. Now let's talk about another advantage: low cost. Because index funds simply follow an existing index instead of paying teams of managers to constantly buy and sell investments, they usually have much lower fees. Here's something many people don't realize. Fees matter. Even small fees can add up to over 20 or 30 years. The less money that's going towards fees, the more money stays invested and has the opportunity to grow. Now, here's another reason I like index funds investing. It's simple. You don't have to spend every day watching financial news. You don't have to guess which stock will be the next big winner. You don't have to panic every time the market has a bad week. Instead, you stay focused on the long term. Because investing isn't about getting rich this year. It's about building wealth over decades. One of the biggest mistakes new investors make is believing they have to beat the market. The reality is, very few professional money managers consistently outperform the market over long periods of time. That's why many investors choose to simply own the market through index funds instead of trying to outsmart it. Now, does that mean index funds never lose value? Absolutely not. The stock market goes up and the stock market goes down. That's normal. There'll be years when your account grows significantly. There'll be years when your account declines. The key is understanding that long-term investing requires patience. One of my favorite sayings is this: short-term volatility is the price we pay for long-term growth. If you're investing for retirement that's 20, 30, or even 40 years away, daily market swings become much less important. The goal isn't to time the market. The goal is to spend time in the market. Now let's talk about consistency. As I teach in stage 4 of the 7 stages to financial independence, the wealth building zone, I encourage people to invest consistently. Notice, I didn't say occasionally. I said consistently. One of the best ways to do that is by investing every month. Whether the market is up or market is down, you continue investing. Why? Because when prices are lower, your money buys more shares. When prices are higher, your existing investments have the opportunity to grow. This disciplined approach helps remove emotion from investing. Instead of asking, is today the perfect time to invest? You simply stay committed to your long-term plan. Now, I also want to clear up a common misconception. An index fund is not a guarantee that you'll make money. Every investment involves risk. The value of your investment can go up or down, and it's possible to lose money, especially over shorter periods. That's why it's important to invest with a long-term perspective and choose investments that fit your goals, time horizon, and comfort with risk. For many people, index funds can be a great foundation for a diversified retirement portfolio. They're simple, they're low cost, they're diversified, and they allow you to participate in the long-term growth of a market without trying to predict which individual stocks will be tomorrow's winners. So if someone ever asks you, what is an index fund? Here's the simple answer. It's a way to own a small piece of hundreds of companies with one investment while tracking the performance of a specific market index. Simple, diversified, long-term focus, and designed to help everyday investors build wealth over time. I'm Coach Wade, and I believe investing doesn't have to be complicated. You don't have to know everything about Wall Street to become a successful investor. You just need a solid plan, a long-term mindset, the discipline to stay consistent, and the patience to let time do what it does best. Because remember, wealth isn't built overnight. It's built one investment, one paycheck, 1 month, and 1 year at a time. I'll see you in the next lesson.